In this screencast, we will review the concept of petty cash and its role in business operations. Most businesses today require all disbursements of cash to be made via electronic transfer or double-signed checks as a means of basic control activity, allowing companies to accurately monitor cash outflows. So this may leave you asking, what is the need for petty cash funds? To begin, it is important to understand what a petty cash fund is. A petty cash fund is the amount of cash kept on hand to pay for minor expenditures incurred by a business. In many instances where minor accounts of cash are needed, the process of writing a check is burdensome, and in some cases checks are unacceptable. For this reason, businesses establish a fund with the foresight to compensate for any expenditures that may be incurred. This could include things such as purchasing a coffee for a meeting, or purchasing office supplies when needed. Now that we have a better understanding of what a petty cash fund is, it is important to note the three main components of one. The three activities essential to an operational petty cash fund are establishing the fund, making payments from the fund, and replenishing the fund. A petty cash fund is established by writing a check for the amount of the fund, cashing the check, and then placing the cash under the care of an employee who acts as a designated custodian. It is essential that a journal entry is made to record the establishment of the fund where petty cash is debited and cash is credited. Essentially, the establishment of the fund simply designates cash to be used as part of the fund, as total assets at this stage remains unchanged. Following this, making payments from the fund occurs when cash is used to pay for expenditures. Cash can either be taken from the fund to make a payment, or employees can pay using their own money and seek reimbursement at a later date. Regardless of the method of payment used, custodians should always collect receipts as payments are made from the fund and no journal entries are recorded. Finally, replenishing fund is essential as cash begins to decrease in the petty cash fund. In order to replenish cash, first, remaining cash in the fund is counted before a check is cashed by the company that replenishes the fund back to its original balance prior to expenditures. That may be a lot to follow, but here's an example from ACCT Financial 2nd Edition to help you understand. On the 1st of May, the fund is established where a $100 check is cashed and the subsequent funds are allocated to petty cash, as shown by petty cash being debited and cash being credited. As the month of May progresses, expenses for postage, office supplies, and various other things are incurred, where receipts are retained and no journal entries are recorded. On the 31st of May, the petty cash replenishment report is prepared, where cash needed to replenish the fund is subtracted from the original balance in order to decipher the amount needed to replenish the fund. Expenses incurred throughout the month are recorded using their receipts and a journal entry is then made. On some occasions, the custodian may fail to gather the correct receipts or will give you incorrect change, which leads to a discrepancy in the cash needed for replenishment and the amount of receipts. In these circumstances, the discrepancy is charged over the cash over and short account. The cash over and short account is a temporary account that can have either a debit or credit balance. Hopefully now you understand the role of petty cash funds in organizations.